So what advice would you offer to investors during periods of high volatility?
Yeah, during high volatility, one strategy I use personally is dollar cost averaging, or just averaging into the market. It kind of ensures you don't get stuck at a high point. Another thing I think is quite important, particularly given the current market outlook, there is still some fear around a larger market drawback if things turn a bit more sour from higher interest rates. So in that scenario, I think liquidity is really important. Having that optionality of cash, which is one of the great benefits of ETFs actually, since they're market traded, you can easily convert those to cash when needed and take on different opportunities.
Yeah, I'd love to get your thoughts on fixed income. What do you reckon will be an option for your fixed income? Or what do you reckon will be a risk next year?
Yeah, that's a good question. Actually, I just thought of this. I should have brought this up in the opportunities when you asked me around that, because I see fixed income in a really good spot at the moment, particularly fixed rate bonds. So just thinking, the past month, so we're just at the start of December now, the past month we've seen US 10-year bond yields come down about 100 basis points. So, if you think about fixed income and fixed rate bonds, they perform better, or they have greater capital appreciation when yields come down. So if the market expects, rates to be cut, which it currently does, but to a further extent, you can see greater capital appreciation. So as an example, over that past month, we've seen, one of our funds, it's an ultra long duration US government bond fund, essentially long dated bonds. They're more sensitive to movements in the yield curve. That's up 15%, which is, equity-like returns from bonds, which is pretty exciting. So just given that starting point that we're at with really elevated yields at levels we haven't seen for over a decade, you're getting paid really nice compensation to jump in and a really good buffer for any volatility in yields. And B, if we do see rates get cut and further expectations of rate cuts, you can see really strong capital appreciation. So fairly constructive on particularly fixed rate bonds, but also floating rate bonds at the moment too, just because of how elevated interest rates are globally.
Yeah, definitely. And lastly, so based on your experience, what are common misconceptions about investing, and what do you think people often get wrong?
Yeah, it's a really good question. I think, and it kind of touches on a few of the things we've talked about already, but I think for me it's that timing the market versus timing the market. If we had this conversation this time last year, I probably would have said expectations were for a market pullback and a mild recession during 2023, which I think was fairly consensus across a lot of the large investment banks. And what the NASDAQ 100's up 50% this year. So I think it's just that you never really do know. So it's really important to keep investing, and when you do keep investing, you're benefiting from things like compounding returns, and also that conversation about dollar cost averaging in. If you are wary, stay in the market but just work your way in, and that way over the long run you'll probably be better off than trying to pick the top and the bottom.
Definitely. Perfect. Thanks, Tom. Appreciate that.
Cheers, Brad.